In this video, we consider supply and demand and the impacts of taxes. So who pays the taxes? When the government decides to tax someone, it generally has two options. These are tax the consumer at the point of consumption or tax the producer at the point of production. And generally, there's two kinds of taxes that can be levied, and these are either a fixed tax or a percent tax. And so in this table, we consider the possibilities. So in this table, you'll notice across the top, you have fixed and percent taxes listed for each column. And on the left, you have tax the consumer and tax the producer for each of the two rows. So notice first that if you tax the consumer, only the demand function needs to be changed. And how are we going to change it? We're going to replace P with the price plus the tax. Because now the consumer, and you've seen this on the receipt if you go to Walmart or Target, you'll see the price and then you'll also see the tax added to that price. And you have to pay both the price and the tax to receive the goods and walk out of the store. Now, if they tax the producer, so it may not be exactly the same, but here you're looking at something like your gasoline taxes. So when you see the advertised price at the gas station, you pay just the price that's advertised. The producer, or in this case the gas station who's selling the product, will receive the price from you and then subtract from that price the taxes that will get passed to the government. So if it's a tax on the producer, only so the supply curve needs to be altered, and we'll alter it by replacing the P in the supply curve with the price minus the tax. So remember, if there were no taxes, we have a point of equilibrium before taxes. And so in our example here, the point of equilibrium is at $20. And if the price per unit is $20, the consumers are willing to purchase 3,000 units, and the producers are willing to make or produce 3,000 units. And so here are our curves, or our functions. The demand function is P equals 50 minus 0.01 Q, and our supply function is P is equal to 5 plus 0.005 Q. So here we're going to impose a tax. In this case, we're going to look at a 7% sales tax on the consumer. So you'll notice we're taxing the consumer, so we're looking at the first row, and it's a percent tax, so we're looking at the second column. So in this case, wherever we see P representing the price in the demand curve, we're going to replace it now with the price plus that tax. So to see how this works, here we have our demand curve and our supply curve. The tax is on the consumer, so we're going to change the demand curve. So our new demand curve is going to be created by simply replacing the price P now with the price plus the tax. And the price is 7% of the price at which it is sold. And so at this point, if we rewrite the equation, we can solve for P and write it as P equals the difference 50 minus 0.01 Q divided by 1.07. So here I have my new demand curve, and I'll use the old supply curve. So to illustrate this on a graph, remember the old demand curve there in the purple or the blue. Now we have the new demand curve, and if you'll notice in the graph, the point of equilibrium with the black curve as opposed to the blue has both lowered production and lowered the price. So here, the new price at equilibrium is $19.54, and we estimate the equilibrium quantity to be roughly 2,909 units if we round to the nearest unit. So let's consider what's happened. So before taxes, the price of the product was $20, and the quantity produced and sold was 3,000. After taxes, the new equilibrium price and quantity, we have $19.54. That's a price drop, and quantity has decreased now to 2,909. So first and foremost, imposing a tax ends up reducing the number of items that are produced and sold. Now let's consider the impact both to the producer and the consumer. So the price used to be $20. Now the price is $19.54. So at the end of the day, the producer now has received 54 cents less per item sold. So although they were not taxed, they are feeling some of the burden of the taxation. Now if we look at the price of $20, the new price now of $19.54, the consumer has to pay a tax, which is 7% of $19.54. 7% of $19.54 comes to be $1.37. So if we add the two together, the total cost to the consumer is going to be $20.91. So consider this. They used to pay $20. Now they pay $20.91. So this is 91 cents more per item after taxes. So the producer receives less for the product and the consumer pays more for the product. So even though one side was taxed, both sides share in the burden. So the tax per item is $1.37. The quantity now produced and sold is 2,909 units. So if we think about the revenue generated from this tax, if they sell 2,909 units and receive a tax of $1.37 for each unit sold, the tax revenue now is $3,985.33. So this is an example of a percent tax on the consumer. So kind of rehash what's going on. What portion of the tax is paid by the consumer? 91 cents. That's how much more they pay for the product. What's the tax burden on the producer? This would be what? 46 cents. They're losing that amount, right, per item. And then the government's take, the revenue generated from this tax, was $3,985.33. Let's consider another tax. Let's consider a fixed tax of $2, this time on the producer. So here we've moved to the second row and first column. So we'll change only the supply curve and we'll replace the price with the price minus the tax. So consider our original demand and supply curves. All right, we're going to change the supply curve now and replace the price with the price minus the tax. Since it's a fixed tax, it'll just be P minus 2, the $2 fixed tax. And so I can simply just add 2 to both sides, and now I've rewritten the equation as P equals 7 plus 0.005Q. So let's consider the graph. Here you have in red the old supply curve, and in black the new supply curve. So what you'll notice is it's moved to the left and up. So what this indicates is the price has gone up, quantity has gone down. And so if we look at this, our new point of intersection, our new equilibrium point, right, suggests a price of $21.33 and a new production level of roughly 2,867. So let's consider this. Before taxes again, the price was $20, the quantity was 3,000 units. After taxes, the price has increased to $21.33 and the quantity has decreased again, 2,867. So obviously, impose a tax, the number of items produced and sold is going to decrease. So let's consider the consequences. So if the price was $20 before, and the price now is $21.33. Remember, the tax is on the producer, so the consumer pays the price and no more. So the consumer is paying $1.33 more per item after taxes. That would be their share of the tax, even though the tax was on the producer. All right, consider the producer. The price was $20. The price now is $21.33. However, there's a $2 tax, and they have to subtract the $2 tax and pass that on to the government. So their keep, what they get to keep, is $19.33. So notice this is 67 cents less per item than before taxes. So the producer's burden due to this tax comes to about 67 cents per item sold. So think about this. For the government, the tax collected per item is $2. The new quantity produced and sold is 2,867. So roughly their total tax revenue would be $5,734. So just to kind of review, the consumer pays more. How much more? $1.33 more. The producer receives less. How much less? 67 cents less. If you'll notice, you add the consumer's burden and the producer's burden, it adds up to be the total of $2. And the government receives in tax revenue a total of $5,734. So here we've shown an example of a percent tax and a fixed tax. We've also seen a tax on the consumer and a tax on the producer. And so to kind of remind you here who pays the taxes, so we want to say who pays the taxes and what kind of tax. And that will identify which of the four possibilities we're going to be looking at. Remember, we only change one function. So taxes on the consumer, change the demand function. If the tax is on the producer, change the supply function.